This is Nadisha in Chicago, and you're watching my channel, Knowledge for Quality of Life. Friends, those who are celebrating Eid uh, yesterday or today, my congratulations to all of you who are celebrating Eid. So last time we looked at it, first topic on inflation, and we looked at it, what the ranges are and, how it panned out over the years. And, we talked about it, that it varies based on many criterias, many conditions, many variables. So today I'm going to look at it, and this was my main focus before I started looking into it. That, how the dollar is going to lose its value over time. And to keep our head above inflation, so what are the options we have? What are the other assets are available so that we can beat that inflation by a decent margin? So we can keep our head above water. So I looked at it, I read many books, first of the book, first book I read, written by late James Towers, who was the founder of American Century Investments. Original name was 20th Century. Then they renamed it. Then they bought Benham, over the years, who were the bond mutual fund company, and they've grown tremendously. And last in the last vlog, I used the word retirement. In let me correct this thing. It's a relative term, and people use in different contexts, right? So for me, retirement is achieving a financial freedom. Once you become a financial independent and you don't rely on that paycheck, you can, step back and, do certain things to keep yourself busy, keep yourself physically and mentally active, so that, you are always engaged. And you can do many things. Different people have different criterias, different wishes, and nobody is stopping you from that. So this is the scenario I had about 35 years ago, and I was looking at various things, reading many things, and to get my understanding. And I read those books. I read periodicals by Value Line, Morningstar, you name it. So whatever I get my hands onto, I was reading it vividly. So I came across many things, and of course, I'm not going to be able to share everything in this vlog, but over the course of time, I'm going to be sharing some uh, snippets of the tools which I have acquired over the years for my better understanding in the area of personal finance. Because my belief is that the more you have understanding and grounding of something, you're going to stick to it in the long run. Because you don't want to get confused, you don't want to get panic, you don't want to sway away from your target plan and all those things. So I started looking at it, and I charted many charts over the years as I've been growing, and but I wanted to show you something that to the current date, what is available, because I did it, for my case from 89 to 2024 or 21 when I retired, and things have changed in few years. So I was trying to figure it out, that what data I can share with you guys. So I found a very nice snippet of a curve which was prepared by Ibbotson and Associates. So let me share the screen with you. So what you're seeing here is what you're seeing here. These are various assets, and so Ibbotson, it's a data collecting company, and that does and they perform many things, and a lot of investment companies buy their proprietary stuff. So it tells you, this chart tells you that, stocks, bonds, treasury bills, and inflation from 1926 to 2024. That's the most recent, because we are in the midst of 2025. It's not done yet, so I don't know how things are going to pan out. But if somebody would have invested $1 in these various assets, how they have grown over time, and this is what this chart is telling you. So the bottom one, you see that inflation 2.9%. So over the course of 99 years, the inflation, if somebody wants to keep the head just neck to neck with the inflation, that dollar has to grow to $18 to have the same purchasing power. That's what it means. And treasury bills, which is 90 days maturity treasury bills, ran about 3.3%. The government bonds, which may include treasury bonds and high yield greater than 10-year maturity, 5%. Large stocks, which you can compare with the S&P 500, Fortune 500 companies, 10.4% compounded. These are all compounded returns over the course of 99 years. And the small stocks, which is the index, you can call it a Russell 2000, which mimics very close to either Wilshire 5000 or Russell 2000, gives you a better index for the small company stocks, just like in comparison with S&P 500. So they did about 11.8%, close to 12%. So now this $1 has grown in these different categories, as I said, $18, $24, $128, $18,212, and $64,417. Now you see that, these on the x-axis, this is the number of years up to 2024. These are the major events which took place. So this is the Great Depression here. You are seeing, stock market crash from early 29, 30 to 33, 34. And then, these are different events like Pearl Harbor during the Second World War, and, all these things, including 9/11, including 1987 crash, including COVID-19, the most recent one. So if you see that, the blue line, which is small company stocks, of course, the rate of return is much higher than the other ones, but it comes with a risk. And you see that risk in zigzag, right? So if you take a short-term period, that zigzag could be more pronounced, but over the course of long term, that zigzag doesn't mean much. Okay, and that's what you are seeing here. So as they say in the investment community, that the risk and reward goes hand in hand. They are very strongly correlated. So the higher the risk, the greater the reward, and vice versa. So this is a conservative treasury bills. So you see that, it hasn't grown much, but it has beaten the inflation in the long run. So this is the scenario which we are looking at it, and for the last 3-4 years, of course, the large company stocks are in favor, so they are doing better than the small company stocks. And we will look at it, some value indicators that, how they are trading, and how to gauge that thing, how I actually looked at it things in the past, and how I'm looking at it now. This based on my understanding. So this is the chart I wanted to share with you. Now, taking this chart and applying to our case scenario. So let me share the next slide. So in the last vlog, I mentioned rule of 72. This is the power of compounding. And Albert Einstein said about rule of 72 or power of compounding as the 8th wonder of the world. I have actually a quote, somewhere in my files, and I read it somewhere that, Albert Einstein called power of compounding as 8th wonder of the world. because it gives you a phenomenal crazy results over time, because n is the main thing which we looked at it in the last vlog. The formula for future value of money equals to present worth factor 1 plus I to the power n. N is the killer thing. The longer the number of years you have on your side, you can create phenomenal results. So what it tells you, if you divide the number 72 by the rate of return on your money, the resulting number will be the number of years to double your money, number of years required to double your money. So let's assume, this is the same exercise I did about 35 years ago in my case when I was starting my career, but I'm reflecting these numbers based on today's age. So I looked at it in the data book, that what is the average salary for a 22-year-old who is graduating from a graduating class from a university. So average salary, I'm getting about $68,000 in 2025 dollars. Okay. So if inflation ran about 3%, I took two case scenario, 3% and 4%. And we have seen that, 3% is a conservative number, 4% is a little bit more conservative. So I ran both case scenarios. And we see, historically, we saw that, in the previous slide, that, inflation ran about 3% in 99 years history time. So 3% is a good number to assume. And Fed actually targeting 2% now based on their monetary tightening policy. So the person is starting at 22, so 3% inflation. So if you divide 72 by 3, that gives you a 24. So if you add 24 years, that will put that person into age bracket of 46. And that money, that salary is going to be double, right? 68 is going to be 68K is going to be 136K. Then if you add another 24, so it's going to be 70 years. So let's retire that person at the age of 70. So that salary is going to be $272,000, 272K. So person who's starting in 2025 as a fresh graduate at the age of 22 years, earning about $68,000, assuming that 3% inflation over the course of next 48 years, by the time he or she retires at 70, the person is going to need 272K. Okay, that's the salary. It's going to be required to keep the same, purchasing power based on the inflation, because that's what we see, 3% inflation. And you can do the same exercise at 4%. I'm not going to go over it again. Now, this number I calculated because, if I divide 72 by 4, it puts me 18. So I did, 18 years, make it 40 here. If I keep doing it, 18 adding, because, the number is going to double in 18 years. So it puts me 76. Now, if person decides to retire at 76, that's a different story. You can just double this number. So I'm retiring in both case scenario at 70 years of age. So this number I calculated by how? By this formula. So my future worth of money is going to be this. My present is going to be 68,000. 1 plus I is going to be 4%. So I'm going to use I as 0.04. And, I'm going to compound over next. N is going to be my 48. Because, 70 minus 22, it's going to put me at 48 years. Let me double check. Yes. So it's going to be 48. So now with inflation, in this case, with inflation, retirement income needed, experts say that, we need about 80% of our last salary, which we were earning as our, retirement income, because, you don't have as much as expenses in your retirement age as you would incur in working life, like lunches, clothing and etc., transportation and many things. So I assume 80% of 272K, that puts me at $217,000, right? 217K. Now, they say that, if you have a pot of money, so they say that, if you have accumulated sum of money and you take that 4% withdrawal rate from that pot, every year without running out of the principal amount, the pot. So that's a good number to assume based on the life expectancy. So I assume that target saving needed at 4% withdrawal rate, so 217K divided by 0.04. So the pot of money would be required $5,440,000. So if somebody accumulates this sum by the time he or she retires at 70, this money, and if person withdraws 4% withdrawal rate, the person is going to get this much salary a year, okay, to maintain the standard of living, which is parallel to the when a person started his career or her career. Same number I ran with 4%, and you can follow that 80% of 446,796 is going to be required 357,437, and then at 4% withdrawal, it's going to be 8,935,925. So this is a real number based on the inflation. It seems like crazy at this moment, but trust me that when I started back in 1989 planning like this, I was getting what I am experiencing now. Okay, so it's going to happen whether you believe it or not. It's going to happen, but it's better to be prepared and plan accordingly. That's the kicker thing. Main issue is that we don't fail by accident. We fail because we don't plan properly things. So let me stop share here. So I wanted to give you a case scenario about this returns in the long run. Now, this scenario which I ran about, a case study for a graduate who is graduating in the 2025 at the age of 22. This is what the person is going to need down the line when he or she retires at the age of 70. Now, you can backtrack and then look at it, how to come up with that pot, okay? How to come up with that accumulated target amount so that you can take the 4% withdrawal and live off that withdrawal rate for the rest of your life without encroaching the principal, because you need to have that growth keep going a little bit. Yeah, you can take some conservative stance, but you don't want to completely in the liquid, so that what if you outlive your money, right? There is always a possibility. So hopefully from time to time I'm going to include some different tools so that you can gauge. Now this is the first chart I showed you. This is small cap US stocks only. What international did. So there are many things what emerging market did. So I'm going to be covering everything in a timely manner so that you can cover you can understand bits and pieces, and you can create your better understanding, so you are very well equipped when you have a talk with your financial professionals, or you are picking up your 401k, some funds or mutual funds, you are looking at it. You need to know what are the main ingredients, what are the main tools you can use it to make a better decision. I hope to see you next week. See you then.